real estate is an expensive business and cheap is probably not the best word to describe it, but what if I told you that you could invest in real estate with as little as $1? It might sound too good to be true, but that's the magic of REITs. REITs, I'm not really sure how to say it, but REITs sounds correct. REITs stand for Real Estate Investment Trusts and are a phenomenal way to start getting your hands dirty with real estate. A REIT is a company that owns and manages commercial real estate. REITs are usually traded on markets just like other items such as stocks, commodities, and more. They usually trade at pretty high volumes, allowing them to be considered very liquid, which just means it's pretty easy to convert the REITs into cash. Since you can buy shares of a REIT, you can get the benefits from them like you do with stocks, and one of the main benefits you get from them is the magical dividend income. And by the way, if you want to know more about dividend ETFs, you can click the card, as I just made a video about some of the top dividend ETFs. REITs are required to pay 90% of their taxable income in the form of dividends, which can help you create passive income on the side. Making income this way is really beneficial as it allows you to make money through real estate without putting down large sums of money to buy the property. There's three main types of REITs: equity, mortgage, and hybrid REITs. An equity REIT owns and manages property and generates money through rent. This is different from a mortgage REIT, which gets their money through the interest between the spread of a mortgage loans they give out and the cost of acquiring the loans. These types of REITs are a little bit more complicated, so I'll be mostly focusing on equity REITs in this video. The last type is just a mix between the two, aptly named a hybrid REIT. Now that we know what a REIT is, I want to talk about some of the main reasons you would want to invest in one. The first one, which we already mentioned earlier in this video, is the dividend yield from these REITs. This means that if you have an investment in a REIT, you're getting your money quarterly through dividends. For example, the ticker V&Q offers a 3.57% dividend yield, so for $10,000, you would get about $360 in dividends. The average dividend yield for a REIT is about 4.3%, which is a decent amount considering the dividend yield for an extremely popular fund such as the S&P 500 is about 1.64%. Also, REITs are allowed special tax treatments from the IRS, and so they're only taxed on the income passed to the shareholders, avoiding double taxation, and that allows them to pay higher dividends. I mean, look at this REIT. The Armour Residential REIT has a dividend yield of 20.8%. I haven't properly looked into this REIT, but that's an absurdly high dividend yield. The second main benefit of REITs is the incredible barrier to entry. Unlike a regular property where you could need a down payment of around $200,000, REITs can trade at prices such as $30 and even less. And since many of the new brokers allow fractional shares, you can get these REITs for as little as $1. Granted, it wouldn't give you a whole lot of ownership in the REIT. This ties right in with the third benefit of REIT, and that is its liquidity. If you put $200,000 into a house, it won't be the fastest process to get that money back. On the flip side, if you put money into a REIT and you need the money back, you can just sell the REIT, and since there's so many buyers, you'll get your money back quite quickly. That just wouldn't be possible with traditional real estate. The last major benefit to a REIT is diversification. Many investors invest in the same type of stocks and ETFs, and so adding the real estate sector at a cheap cost is great for diversification. And it's generally pretty hard to invest in real estate without these REITs. Even if you are a multimillionaire, owning a hospital or office building may not be the cheapest or even the best investment. Although there are a lot of benefits to REITs, we also have to look at their risks to better understand their value. One of the risks when investing in REITs is choosing the wrong REIT. It seems simple to choose the right REIT, but just like everything related to the stock market, nothing is truly that simple. For example, if you choose to invest in a REIT that tracked malls at the start of the COVID lockdowns, those REITs would have depreciated extremely quick during the lockdowns. Some REITs are also more susceptible to economic conditions than others, making them a much more risky investment. The second major risk is the dividend taxation. And while this isn't really a risk, it is something to look out for when looking into REITs. Many REIT dividends are not considered qualified dividends from the IRS, so they can have a tax rate that is usually the same as your income's tax rate. This tax rate is probably higher than the standard dividend tax rate, which is just something to look out for. Since REITs also focus on dividend growth, some of them may not grow as rapidly as other growth-focused stocks. However, there's always a trade-off between dividends and growth. On the positive, some REITs have been shown to outperform the S&P 500, which is a good sign for those specific funds. With both the benefits and drawbacks of the REITs listed out, the question is now, how do you pick a good REIT? There's quite a few things you should look for when looking at a REIT, such as funds from operations, or known as FFO, core FFO, debt to EBITDA, and more. To find some of these, you need to go through the REIT's financials and other documents. That's a lot of work, and to be honest, it's not worth the time for most people. That's why I suggest leaving it up to the experts and invest in a REIT ETF. I talk a lot about ETFs because I believe they're the safest and best ways to make money in the stock market in the long term. ETFs will also be diversified as they invest in many different REITs instead of just one. An example of this is the Vanguard Real Estate Index Fund ETF with the ticker VNQ. They hold 167 REITs with pretty diversified sectors. An ETF like this is especially helpful with diversification within the real estate sector, which helps avoid the risk I mentioned earlier about choosing the wrong REIT. With a REIT or any other ETF for that matter, they are long-term investments, and you can't expect to make a quick profit the same way flipping houses can. And the longer you hold a REIT, you'll make more money due to the compounding, especially while reinvesting dividends. While I can't definitively say if REITs are better than buying property, they are great for getting into the real estate sector with not too much money or time. And if that's all you have, REITs are a pretty good investment. If you enjoyed this video, feel free to give it a thumbs up, and be sure to check out some of my other videos.